Hello, India, and a very warm welcome to all the CFOs, finance professionals, and even students who are just beginning their journey into the world of tax. I'm CA Pranav Goyal, and today we're diving into a topic that sounds complex but is actually quite simple if you understand it right. Tax under Section 352 of the Income Tax Bill 2025. Yes, the Income Tax 1961 is retiring after 75 years, thousands of amendments, countless interpretations, and an ocean of compliance. The new law promises to be clearer, leaner, and more structured. But what about charitable trusts, schools, hospitals, NGOs? What happens when they stop being charitable? That's where the concept of tax comes in. Let me break it down in plain language. Imagine this: you are a charitable trust. You've been exempt from income tax for years because you were doing noble work, running a school, a healthcare center, maybe even feeding the poor. Thanks to your tax-free status, you have grown. You have collected donations, bought properties, constructed buildings, made investments. But one day, you decide, I want to shut down. Or maybe I'll convert into a private company. Or maybe I'll merge with another entity that's not tax exempt. And the income tax department says, wait a second, you build all of this with the help of tax exemptions. You don't get to walk away tax-free now. And so, tax steps in. What is tax? In the simplest terms, accredited tax is like an exit tax for charitable institutions. When you stop being eligible for tax exemption because you shut down, change your objectives, convert into a for-profit body, or merge incorrectly, the government will tax you on every you build with those benefits. Section 352 of the Income Tax Bill 2025 lays it out like this. The formula is the accredited income equals the fair market value of assets minus the liabilities. The tax is calculated on the accredited income multiplied by the maximum marginal rate. Example time. Say your trust owns rupees 40 crores in assets. Your liabilities are 10 crores. So the accredited income would be 40 crores less 10 crores equals 30 crores. The accredited tax would be 30%. So you need to pay this tax within 14 days. Events like cancellation of registration, modification, or merger or dissolution. So when does this apply? There are 9 situations mentioned in Section 352, such as the registration is cancelled and no appeal is made. You change your charitable objects and don't apply for fresh registration. You merge with a non-charitable body. You dissolve and don't transfer assets to another registered charity, and many more. So what happens if you don't pay? There's 1% interest per month on the unpaid tax. Also, if you transfer any of your assets to someone else without paying this tax, they may also be held liable up to the value of the asset received. Here's the key takeaway. Accredited tax ensures that charitable benefits are not misused. It doesn't punish, it protects the integrity of tax exemptions. And now, with Chapter 17B under the Income Tax Bill 2025, all the rules about registration, modification, compliance, and exit are neatly laid out in one place. No more running across 20 different sections. So, is this simplification or just better packaging? Well, that's what I'm here to decode, clause by clause, industry by industry, in a language everyone can understand. Because taxation should not feel like solving a riddle. It should feel like a coffee conversation with your favorite CA. So follow me, CA Pranav Goyal, and let's simplify India's biggest tax reform in 75 years. Like, share, comment, save this for your next finance team huddle. Until next time, stay informed, stay compliant, stay smart. Jai Hind.